Ladies and gentlemen, good day and welcome to the Capri Global Capital Limited Q4 and FY23 earnings conference call hosted by Go India Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ravikant Bhatt from Capri Global Capital Limited. Thank you, and over to you, sir.
Good afternoon, everyone. This is Ravikant. I shall read out a brief disclaimer for today's call. The discussion on today's call regarding CGCL's earnings performance will be based on judgments derived from the declared results and information regarding business opportunity available to the company at this time. The company's performance is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially in future. Given these uncertainties and other factors, participants on today's call may observe due caution while interpreting the results. A separate disclaimer is available on slide 2 of the Q4 FY23 investor deck. Participants are requested to note the same. I now request our Managing Director, Mr. Rajesh Sharma, to present his opening remarks.
Yes, good afternoon, friends. Like always, it is a pleasure to welcome you all to Capri Global's post-earnings conference call. We declared our audited consolidated results for Q4 and FY23 on yesterday, that is 22nd May 2023. I hope you had a chance to go through the investors deck. The year FY23 was momentous in many ways for Capri Global. Our car loan business scaled new height where we disbursed close to 6,000 crore car loans in the last year. We launched our gold loan business where we now own a meaningful network, granular retail disbursal overtook wholesale disbursement, and we concluded major equity fundraise with rupees 14.4 billion rights issue, which have taken our capital adequacy to over 40%. However, the standout highlight was our consolidated net profit for FY23, which despite our strong organic growth, push and associated OPEX, and new launch of the gold loan branches nearly matched the FY22 consolidated net profit. This puts us firmly in the saddle to deliver the mid-teen ROE over medium term. Let me therefore start with the earnings highlight first. A combination of a strong net income, which increased 42% year-on-year, and softer credit cost, which declined by 80 basis year-on-year, helped CGCL deliver a strong net profit growth of 55% year-on-year. This also bridged the gap with FY22 consolidated net profit, with FY23 net profit coming in at rupees 2,047 million, nearly equal to the FY22 consolidated net profit of rupees 2,050 million, despite we are in the investment phase in our gold loan branches. The profitability was achieved despite CGCL continuing to expand organically in both urban, retail and gold loan segment in Q4 FY23. But for the OPEX incurred, our net profit for FY23 would have been higher by rupees 840 million. Had not gold loan branches would have incurring the loss, our profit would have been higher to 288 crore rupees. Our lending yields are beginning to show soft improvement with the share of gold loan slowly becoming prominent. We had started gold loan business with a rate offering of 15% in our launch phase. However, we have now moved up closer to or at par with the competition with yields averaging over 18%. In MSME and housing finance business, the loan yields are stabilizing while the construction finance vertical showed further improvement in Q4. The net interest margin has generally trended lower during FY23 compared to FY22. This was due to the initial suppression of loan yields due to foreclosures, migration of higher yielding loans. This was especially the case in MSME and construction finance, where reductions due to foreclosures or repayment were up to 10% higher than FY22. However, with loan yields in MSME and housing portfolio stabilizing and the share of gold loans improving in incremental share, and NIMs should stabilize or improve going ahead, The net interest margin computed on average net advances was 8.6% in Q4 FY23. Is shade better than 8.5% in Q3 FY23, but lower year on year. That is also because our leverage has gone up. We have been discussing our non-interest income in some detail since past 2 quarters. We have included a separate slide in our Q4 FY23 presentation. Please refer slide 15. The share of non-interest income was 36.3% in Q4 FY23. On a full year basis, the share of non-interest income in net income was 33% during FY23 compared to 23% in FY22. Net car loan distribution fees contributed 40% to FY23 non-interest income compared to 19% in FY22. The car loan distribution business saw originations increase 3.5 times year on year to touch rupees 60 billion. We are now present in 450 locations, including 9 branches across the country. Our cost income ratio, which hit a peak of 69.5% in Q3 FY23, softened marginally to 68.2% in Q4 FY23. Excluding the cost incurred for expansion in gold loan vertical, our cost income ratio was 48% in Q4 FY23. Our operating cost was higher in Q3 FY23 as our hiring was high owing to planned gold loan branch rollouts. With gold loans reaching a significant milestone in network strength, our hiring shall be more even paced, leading to well spread out operating expenses in FY23. We will have a network of 750 branches for gold loans by end of this quarter, reaching the 50% milestone of total 1,500 branches we plan. We also expect this gold loan branches network to reach closer to break-even in FY23, with gold loan AUM expected to touch rupees 25 to 30 billion. This will also soften the incremental impact on operating costs and soften cost income ratio significantly. The credit cost declined to rupees 112 million in Q4 FY23 from 245 million in Q3 FY23 and rupees 571 million in Q4 FY22. On a full year basis, our credit cost was rupees 642 million, declining 39% year on year. The full year credit cost was 80 bips lower compared to 192 bips in FY22. Asset quality improved with the stage 3 asset declining 81 basis year on year and 73 basis quarter on quarter to 1.59%. The PCR of stage 3 asset was 32.2%, highest since Q4 FY21. We have taken negligible write-off during Q4 FY23. I shall now discuss business performance. Assets under management crossed rupees 100 billion to touch rupees 103.2 billion. This is a 56% year-on-year growth. The share of retail loans improved to 79% in FY23 from 76% in FY22. The share of construction finance segment where growth was stronger in H1 FY23 due to a strong sanction disbursement pipeline softened 400 basis quarter on quarter to 18% in H2 FY23, below our threshold of 20%. This is in line with our previous commentary that construction finance momentum shall be softer in H2 FY23. Disbursements touched rupees 28,110 million, growing to 87% year on year and 55% quarter on quarter. Disbursements in FY23 stood at rupees 72,902 million and were up 70% year on year. The share of retail disbursement comprising MSME, affordable housing and gold loans was 76% in Q4 23 compared to 49% in Q4 F22. Gold loan led momentum in disbursal during Q4 FY23, constituting rupees 9,582 million or 34% of the total disbursals. This translated in gold loans AUM touching rupees 11,259 million, constituting 11% of total AUM compared to 8% and 2% share in Q3 FY23 and Q2 FY23 respectively. This rapid scale-up was supported through an expansion of exclusive gold loan branches, which has increased to 562 branches in Q4 as compared to 449 in Q3. The car loan distribution business continued with a strong momentum. As shown in slide 12, the loan origination touched rupees 2,324 million, up 2.7 times year-on-year and 20% quarter-on-quarter. Total origination in FY23 stood at 60 billion, over 2.5 times in FY23 origination, which were 17,022 million. I shall discuss the fee contribution from the vertical while commenting on earnings performance. Our fee income in card loan distribution alone have reached to about 118 crore rupees in FY23. As of Q4 FY23. In this strong growth backdrop, I would like to highlight we enhanced our capital adequacy ratio by 40% for CGCL from 24% in Q3 FY23. The capital adequacy ratio has been boosted by the rupees 14.4 billion equity raise we did in March 23. We have deployed rupees 2 billion of the money and shall be able to fully deploy the equity in Q1 FY24. Going ahead, we shall aim to sustain the AUM growth momentum about 30% in FY24. Our profitability should also improve as our gold loan branches move nearer to breakeven. With that, I conclude my commentary. We shall now take questions. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from Mona Ketan with Dolat Capital. Please go ahead.
Yeah, hi sir, good morning. So my first question is on the gold loan book. What is the typical tenor here, and is there scope for further rise in yields from here on?
Yeah, so our gold loan typical tenure is about 6 months, and what is your next the second part of the question was?
Could the overall yields, which are at 18%, is there scope for further rise in the yield?
No, so 18% is our boarding yield, but realized yield, because most of the schemes are rebate schemes where on the default the interest will go further. So we expect the realized yield will be in the range of about 20.5%. We additionally realize about 2.5% interest above the boarding yield.
Okay, which comes in the fee line.
So which come in the interest income only.
Okay, so eventually this will stabilize at 20% or so, the overall yield.
Yeah, but that happens is the new business. That will happen once you reach the loan tenure on the completion side, because default and you realize the default interest, that happens over a period of time. So you will see this quite evident in the H2 FY24.
Sure, got it. And what percentage of gold AUM will have the yields below 12%?
So below 12% will be less than 10-15% portfolio, which is only done of the gold loan portfolio, which is only done with the view to park our surplus treasury money rather than putting in a mutual fund. We can always devise certain schemes where we use the treasury product and we can park that money at 11, 12%, 13% kind of rate of interest.
Mm-hmm. Got it. Secondly, on the home loan book, we see a sharp rise in the average ticket size on a Q-on-Q basis from 12 lakh to 16 lakh. So what has led to this? And also if you could share what are the sourcing channels for the home loan book?
So home loan book sourcing channel is we have our own direct sales team which procure the entire home loan book.
Okay.
And ticket size home loan has gone up because I think this is the impact of the home loan ticket size is growing in terms of the cost of the houses are growing. At the same time, our expansion and few cities, the average ticket size of the loan have gone up.
Okay. Got it. And just one final question again on the gold book. What is the breakup by ticket size, the gold AUM breakup? That is, above 5 lakhs, what percentage of book, maybe below 1 lakh, what percentage of book and thereabouts?
So I think we can give you that separately. At the moment, it may not be that handy.
Okay, sure. Thank you. I'll come back in the queue.
Thank you. Our next question comes from Hitesh Gulati with Haitong Securities. Please go ahead.
Yeah, thank you, sir, for giving me the opportunity, and congratulations on a good set of numbers. Sir, a couple of questions from my side. Firstly, sir, you've spoken in some media interactions about digital lending and some new products. Can you throw some light on that?
So digital lending at the moment in the phase where we are just discussing with the few fintech players to tie up, where we will be disbursing the loans to which are originated and guaranteed by them. But recently there are some changes in the RBI guidelines in the FLDG and all. So we are reviewing that. Once there is a clarity and comfort on our repayment obligations and some sort of comfort from the fintech who originated, based on that we'll take a call. While we have a team in place, but still it is away by at least 3 to 6 months.
And so some other products on the pipeline in the lending side?
No, lending side there is no other product. We will consolidate what we are doing and we'll focus on gold loan branches to make them achieve faster break-even.
Sure, sir. And sir, last question from my side is, gold loan is right now 11% of AUM. What is our target for this, and what is our overall AUM growth target for the company?
So overall AUM growth should continue to grow between 35 to 40%. And now adequate capital also is in place. And with the gold loan AUM over a period of next 4 to 5 years, it will be about 25% of the overall book, consolidated book.
Thank you, sir. That's it from my side.
Thank you. Our next question comes from Pushkar Jain with Sequent Investments. Please go ahead.
Hi, sir. Congratulations on great set of numbers. Thank you for taking my question. My question is on competition from banks. Last 3-4 quarters, we have seen a lot of competition, in terms of yield from banks for gold loans. Is the competition yield? How is the competition shaping up right now, and what percentage of our book would be yielding less than 15% in gold loan?
So yes, competition is increasing. I think gold loan, but market is increasing by 12 to 13% year after year, and still the majority of the gold loan market is still with the informal lenders and jewelers who lend at very high rate of interest. So market will continue to move from unorganized lenders to the organized lenders like of NBFC and bank. While bank target the higher ticket size and the customers is different, NBFCs and gold loan focused NBFC target the retail customer with ticket size in the range of about start from 10,000 and goes up to 2 lakh rupees. So the segment is quite different. Despite competition, as I said, the majority of the gold loan market which is unorganized will continue to shift, and we can see good growth in next 4-5 years in this.
Right, sir. Right. Okay. Thank you so much.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star, then 1. Our next question comes from Jay Dakshini with IIFL Securities. Please go ahead.
Hello. Thank you for taking my question. So, our gold loans in segment, we were targeting 1,500 branches over the next 4 to 5 years, but we have already opened 550 branches within the last 8 months. So, could we actually reach our target within 2.5 years, and how will we our growth in next coming years? And also, how will this affect our OpEx movement and CI?
So at the moment, we'll take a pause at 750 branches, and we will make them become profitable before we start the next phase of round 2 of balance 750 branches. Currently, our focus is to make them achieve the target business numbers and achieve profitability faster. So our cost income ratio, which is at the moment elevated, will come back to the level of about maybe between 45 to 50%. And when the profit will start giving, I think it will further show the improvement there.
Okay. All right. And one more question. In the construction finance, our ATS have declined QOQ. So is that any color on that? Like 191 to 18 million on slide 9.
Just a moment. Can you repeat the question, please?
Yeah, in the construction finance business, our ATS has declined from 191 million to 18 million.
No, so I think because of the font size, it's got a bit hidden. It's not, you rectify that. It's high.
It will be 180 million, right?
Yeah, correct.
Okay. And our GMP has declined in SME segment by 120 basis QOQ. So how do you think this segment could be growing up in asset quality wise, and what's the strategy as of now? Hello?
You are asking specific to MSME, which is the side you are referring to. Can you please say that?
Yeah, SME segment, GNP has declined 120 basis. So QOQ.
So this is the overall. This is not talking about a specific segment. This is at a consolidated level of the company.
Yeah. So what's the growth plans in this vertical as of now?
No. So as far as GMP is concerned, that is the overall of the company. As far as the growth of the vertical of MSME is concerned, MSME will continue to grow in the range of 25 to 30%.
Okay. Yeah. Got it. Thank you.
Thank you.
Thank you. Our next question comes from Nikhil Nayati with Aquarius Securities. Please go ahead.
Hi, sir. Am I audible?
Yes, please. Please go ahead.
So my first question is on the gold loan yield. I see a sharp improvement on a QOQ basis, which is reported on slide 16. Can you throw some light upon that, and how much of it is attributable to the penal interest or the overdue interest, if any?
This is the onboarding yield, sir. Onboarding yield would have increased.
Yeah. So, if you talk about the gold loan, the onboarding yield of now we are reaching about 18%. We expect about 25 to 30%. Overall basis, we get the default interest rate.
Okay.
Plus, we also gone granular from high ticket size. Jeweler used to come. We have gone to the retail consumer. So our ticket size is dropping, and so our interest is also going up. Plus, initially when we launched the loan, we were more focused to make our presence felt in that particular branches network. So our yields were lower. So with the combination of all these three impacts, our yields have gone up.
Got it, sir. And sir, second question is on the cost of funds side. I have seen our cost of funds have remained fairly stable over the last year despite the rate increases. So how do you see the cost of funds panning up in the next 3-4 quarters?
As you know that interest rates are borrowed from PSU bank by us, where the interest rates are reset annual basis. So while the interest rate have gone up, the impact comes when the interest rate are set. Majority of the resets were started from quarter 3, and all the reset have happened by end of March. So our interest rate will go up by another 40-50 basis points, and we are quite confident that we are able to pass on this interest rate to the new customers.
Got it, sir. Got it. Thank you. This answers my question, and congratulations on a good setup.
Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star, then 1. Our next question comes from Mayur Lehman with Profit Mart Securities. Please go ahead.
Thank you, sir, for the opportunity, and congratulations on a good set of numbers. I just want to ask what are the parameters push the performance of Q4 FY23 and the full year of 2023?
Can you please repeat the question?
Yes, sir. Sir, what are the parameters push the performance of quarter 4 and the full year of 2023?
Can you be specific? What exactly you wanted to ask?
Means, if you give me details about the gold segment and the car loan distribution, it will be good.
Car loan distribution, if you talk about, that have disbursed close to 6,000 crore worth of car loan, and we had a revenue from that about 118 crore rupees.
Yes, sir.
If you talk about gold loan AUM have stood about 1126 crore rupees, and where the average yield is about 18%.
Yes, sir. But what are the means market scenario push these drivers? So means if we look the income, main operation income, so it will raise. It was raised. Sorry. So means I just want to know what are the market economical factors push the business towards the forward.
If we sum it up, going forward, our car loan distribution business next year will grow about 50%, and that will give a pure fee income where no capital is to be required. And that will improve our fee income ratio to the overall income that has already improved from 22% to 33%. And overall basis, our AUM will continue to grow about 35 to 40%. And since as we said, gold loan branches are now achieving 1 year period in the next year, so those branches will be near to break even, or some of them will become profitable. So overall cost income ratio will drop. So we see that the next year should be a significant upside in profitability.
Okay. Okay, sir. Sir, I got my answer. Thank you so much, sir. And the best of luck, sir.
Thank you.
Thank you. Our next question comes from Ashish Kumar with Infinity Alternatives. Please go ahead.
Thank you, sir. Sir, on the car loan distribution business, you mentioned that we have got a revenue of 118 crores. What will be the profitability on that business, sir? The cost income ratio, just to get some sense.
So from 118 crore top line, we would have got a profitability close to about 32 crore rupees kind of a profitability from that segment.
And sir, there's no balance sheet exposure to that?
No, because we are just referring lead originated by our team to the banks who are partnered with us. We are partnered close to 8 banks. And on successful conversion of that lead, we are paid a fee by the banks. And that is what our business model is.
Okay. And sir, just to understand, what is it that we are doing differently as compared to so many other people that we've been able to build up a car distribution business so quickly? What has clicked for us?
So we have touch point. We have built a strong network of our own team, and since we have distribution network and we are focused only on the new car, we are able to do with a quick turnaround, and we know that which customer will fit in what interest rate. So we run that program and able to offer the customer very quickly. Suppose somebody apply, whether he'll get a good interest rate at Bank of Baroda, HDFC Bank or Bank of India, we are able to tell him. And we help the customer to do that decision quickly and make him available funds to buy his car quickly. So I think the turnaround time and the right kind of a rate of interest matching his income profile help us to get the better business.
But so is what, let's say, some of the larger distributors like Andromeda, etc. do.
So I do not know exactly what is the business model of Andromeda. But as far as we are concerned, we have about 450 touch points, our own feet on the street people along with them. So that is helping us, and we are adding another locations and few more bank partners this year. So this year again we'll see a 50% growth in that.
Okay.
Currently in the new car loan disbursal, other than the dealers, I think we are the number one.
Okay. Okay. Thank you, sir. All right. And wish you all the best.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star, then 1. Our next question comes from Gaurav Sharma with HSBC Securities. Please go ahead.
Hello, am I audible?
Yes, please.
Yeah. Hi, sir, I have a couple of questions. One is regarding the borrowing mix. So since you have a large portion of borrowings from scheduled commercial bank, I want to know what will be the breakup of this into MCLR rated linked bonds, EBLR linked bonds, and repo rate linked bonds, if any. That is first. Second, I just wanted to know what are the cross-selling opportunities you are exploring in your loan product. These are my two questions.
So we don't borrow anything SLR or EBLR linked bond. How we borrow money from public sector bank is a term loan, and there is less than 5% money in the shape of non-convertible debenture, which you have borrowed from the bank when the TLTRO scheme were announced, which are getting repaid. By the end of the next June, I think every NCD except with one from financial institution will remain outstanding, which is very small amount. So rest of them are the term loan ranging from 5-year to 8-year tenure.
Okay, got it, sir. And upon the cross-selling opportunities in lending products?
So currently we have MSME branches, home loan branches, and gold loan branches plus car loan distribution. Going forward, whether it is a gold loan or MSME loan, I think our all gold loan branches will convert into loan center, and they will start also cross-selling the home loan and MSME loan. In any case, MSME loan branch also cross-sell the home loan. So our technology is under development. That will take another 6 months to 9 months time. And once that takes place, then we'll launch the pilot, and then we'll make full-fledged all the gold loan branches converted into the loan center. So the cross-sell opportunity will rise exponentially.
Okay, sir. Got it. Thanks. Thank you so much, sir.
Thank you. Ladies and gentlemen, a reminder, if you wish to ask a question, please press star, then 1. Our next question comes from the line of Sadhru Chakraborty, an investor. Please go ahead.
Yes, hello, thank you. Can you hear me? Well?
Please.
Okay, my first question is on the MSME business. Here in the slide, I see that the average ticket size has increased, the accounts have increased, let's say 20%. Can you just throw some light on how you see the segment going forward in fiscal year 23 and 24? Any stress or strain that you see in this segment, and just in general, what is your vision of this segment progressing forward?
So, if you talk about MSME, I think going forward, if you've seen that earlier we had about restructured pool of about 200 crore plus amount, which has come down to about 93 crore, which is clearly showing the good result. Going forward, our average ticket size will continue to be in the range of less than 25 lakh rupees, which is currently today about 19 lakh. The average ticket size will not move up, but since we are adding more branches, the distribution network will strengthen. Some point of time, our gold loan will also do the cross-selling. So MSME business will grow, and I think this will remain one of our key growth drivers.
Okay, thank you. Similar question also for the housing finance business. I think you mentioned that the average ticket size has gone up. That is clearly visible. The loan to value looks pretty similar. Accounts have gone up. I was just concerned a little bit about the geographical distribution. Do you see yourself expanding into any other geographies, or what exactly is your strategy for the next 2 years for housing finance?
So housing finance, we are adding the new branches in Uttarakhand and Uttar Pradesh, and this year we'll be adding another about 25 to 30 branches there. And plus, we are adding some of our existing locations where business is happening good. We are adding more manpower strength there to source and underwrite that business. So overall, I think housing finance will be, in terms of percentage, will grow in the range of about 55 to 60% for next 2 years.
Okay. And then the last question from my side was really around your capital structure. Well, not really the structure, but the capital that you raised in the rights issue. So congratulations on doing successfully raising that. When I look at the gold loan business and the opportunities that I see, I have a strong sense that capital cover, let's say, will sort of run down in 2 years. Is there any long-sighted vision of what you want to do again? And if you want to do a capital raise, will it be from public shareholders? Will it be from NHB? Will it be from other banks? Or just any vision of how you see the capital base basically going forward for the next 2 or 3 years?
So last time we raised capital was in 2010. Now we raised, even that is the right issue where we put in a significant amount of money. I don't think company will require capital for next 6 to 7 years. And in case the co-lending takes off, company may not need the capital even for the 10 years.
Okay, very helpful. Thank you and all the best.
Thank you.
Thank you. Ladies and gentlemen, a reminder, if you wish to ask a question, please press star, then 1. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Yeah, thank you all for attending this call. So as we stated earlier, we continue to build the granular book, and we continue to cater to the same segment which is not catered by the banks, be it MSME, be it affordable housing, be it gold loan, and even be it the construction finance, smaller developer. So I think we clearly see that backed by our strong distribution network and a good capital adequacy ratio, and now almost we achieved 10 years in lending business. We already established our underwriting standard and good collection team. We invested heavily in the collection team as well as the collection systems and chatbots and auto dialing and all that. So in back of that, where the collection is the heart of our entire thing, we feel that the company will continue to grow in next few years at a range of about between 35 to 40%. And gold loan branches will convert into the loan center, which will further bring our operating costs down. So overall, between 3 to 4 years, you will see significant hike in the margins as well as the improved return on equity in ROEs. So thank you all.
Thank you. On behalf of Go India Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your line.